His name is Howard Marks. You know him as the co-founder and co-chairman of Oaktree Capital Management. It's a credit investment firm with $100 billion in assets. I've had the pleasure of getting to know Howard quite well over the last few years, and I think the opportunity to speak to him here is an even greater pleasure. Howard, please join us. So, by way of background, if you read Howard's memos, and you should, you already know how insightful he can be. Howard started on Wall Street in 1969, and he's been a professional investor since 1978. In 1990, he started documenting his thoughts, theories, and philosophies on investing, and he has continued through, as we'll all agree, some of the most extraordinary and extraordinarily challenging times for financial markets. We can go back to the Great Bond Massacre of '94. We can talk about the Asian currency crisis, the Russian default, the dot-com bubble, the financial crisis, the European sovereign debt crisis, the crises, go on and on. During that period, as I mentioned, he has built Oaktree, with some help, into a firm overseeing $100 billion. Today, I've asked Howard to contemplate a deliberately provocative question he hasn't yet covered in his memos, and this is it. Is capitalism broken? Now, I could run you through a long list of reasons why this may be the case, and we'll probably get to some of them. But I would rather begin by hearing from Howard and seeing where this conversation goes. Howard, is capitalism broken?
Well, I think that as with many things, the easy gains come in the beginning against little resistance, and the greatest steps are taken in the beginning. And then excesses develop. You know, one of my favorite sayings is that what the wise man does in the beginning, the fool does in the end. And missteps come later. And so I don't think it's over, but I think it's more complicated today than it was 100 years ago.
Well, I mentioned that I have a long list.
Yes.
So let's start going through the list, because any one of these things in and of itself might not be considered a sign that capitalism is broken, but collectively it raised some questions, and I want to go through them with you. Let's talk about monetary policy. We know that financial markets are prisoners, if you will, to monetary policy. Recognizing that markets are an essential tool for capitalism, right? Price-setting mechanism. How useful is the Japanese bond market as a price-setting mechanism if the central bank there isn't just running a negative interest rate policy for overnight rates, but actively buying and selling to keep the 10-year yield at zero?
Well,
and of course, that's just symptomatic,
yeah,
right, of the extraordinary measures central banks have taken.
Yes, because it's, you know, you shouldn't just be asking about Japan. Many places have set interest rates at zero and bought long-term bonds as well. Mm-hmm. So I think that all I would say is that we believe in free markets. We believe that the free market is the best allocator of resources in the long run. And that's the essence of capitalism. That's the essence of the success of the United States in large part, although we do have regulated industries as well. But we don't have a free market money all around the world, and we haven't had for 5, 6, 7 years. And that's unfortunate. And you know, I kind of liked Keynes's approach, which is that when the economy's in the soup, you run a deficit, you spend more than you bring in, and that stimulates the economy and brings it back. And then when the economy's doing well, you run a surplus, and you spend less than you make, and you pay off the debt. And everybody's forgotten about that latter part. And now they think the Fed, the central banks can manage their way to prosperity, and I don't believe it. I don't think that central banks can create growth and should be in long term and permanently in the business of controlling the money market.
Thinking as a long-term investor, which is what you do, if the markets aren't free.
The thinking or the long term?
Thinking as a long-term investor.
Yes.
Which is what I think of you as.
Thank you.
how do you invest confidently if it's not a free market?
Well, I think the answer is, well, first of all, our investments are not driven by the macro, and we're not macro investors, and we're not Fed watchers, and we're not economists. We are micro investors. We invest one company at a time in companies where we feel we are well paid to take risk, and where we think the outcomes are predictable. So in general, Eric, we don't make judgments about that, the macro. You know, it's very easy to make those judgments. It's hard to make them correctly, and it's harder still to have the events you predict materialize on time. And when they don't materialize on time, you get into trouble. And I think that, you know, you can name on just a few fingers the people who are famous for getting macro right. I think of trying to guess at these things as an opportunity to make mistakes. There are a lot of people who went to cash at the beginning of this year and thinking that there was a lot of uncertainty and low prospective returns, and that prices were high, all of which was true, and they missed a lot this year. And so I think getting in, getting out, very, very challenging, not something we do.
Here's a consequence of these low rates that maybe or maybe not raises some questions about capitalism. Returns don't reflect the risk of loss. This is not the first time that's happened.
Right. No, returns are extremely skimpy, thanks primarily to the central banks lowering what we call the capital market line, with an origin of a risk-free rate close to zero and everything else proceeding from there. So we have very, very low prospective returns at the same time that we have great macro uncertainty. That's not an attractive combination. But the challenge is, what do you do about it? And I reject the idea of getting out of the market. Among other things, our clients need return. And they can't say, we'll take zero. If you're a pension fund or an endowment, you need return. And similarly, when they hire us to do a job, we can't say, we're going to keep it in cash and make zero for a few years, waiting for better opportunities. I mean, we can do that, but we better be right pretty soon, or else we'll be out of business.
Is there a moment when it's appropriate to get out of the market, in your words? And if so, when might that point be?
Well, there is, I think, when there's a demonstrable bubble. And when psychology is crazy bullish, and the risks are extremely high, and valuations are extremely high. Implicitly, I'm saying I don't think that's today. I think things are elevated to the point where you have to proceed with considerably more caution than usual. But I do not think that we are in a dangerous bubble.
What might the next dangerous bubble look like? You know, when do those valuations reach the nosebleed level that drives you out of the building?
Well, I mean, for example, we don't manage money in the mainstream stock markets. But in the S&P, you know, the PE ratio is about 19 today versus the post-war average of 16. That's a little high. In 2000, it was 32. That was a bubble. And so I think that bubbles are connoted by extremely high valuations, and also by bubble thinking. And bubble thinking says, for example, nothing bad can happen. There's no price too high. This can't lose. Now, those things sound nutty, but I've seen them several times in my life. And we've seen bubbles ranging from the nifty 50 bubble, in which IBM, Xerox, Kodak, Polaroid, Avon, Merck and Lilly, and et cetera, were selling at 80 to 90 times earnings in 1968, 69, to the tech stocks and the internet stocks. You know, in 1999, people said, you know, the internet will change the world. This is an internet company, so consequently, there's no price too high.
So at that time, and
Yes.
times like it, you saw people blindly following the herd.
Right.
But they are, if not blindly following the herd today, they're also doing some things somewhat blindly,
Right.
like reaching for yield.
Yes, yes.
So does the next bubble necessarily need to look like the last one?
Well, you have to make judgments, you see, and these things are not black and white. And so this is a time for caution, but this is not, in my opinion, a time of maximum risk. You know, we are primarily credit investors, and if we can buy debt of companies that we believe, we think for good reason, will pay their debts, then the worst that will happen is we'll get the promised return. Number one, the promised return may prove to be inadequate. Number two, there may be interim declines in price, which are painful. Number three, those interim declines in price will provide a better time to buy than today. All that's true, but still, if you buy and you're discerning about credit and you're right, you'll get the promised return, and that's not the end of the world. When I talk about a bubble, you know, in 2006-07, it was really easy to issue paper that we were pretty sure wouldn't be repaid. And when it's easy to issue paper that won't be repaid, there's something wrong in the markets, and that's the time to get out.
Here's a question that you touched on, I think, in one of your first remarks. One of the biggest questions that investors must ask themselves in order to set expectations accordingly is whether the future is going to be as good as the past. Will it?
I don't like being a downer, but I don't think so. You know, I was very lucky to be born 70 years ago and to have lived through the greatest period in history, the best time in the best place. And it doesn't stand to reason to think that, number one, everything will always stay the same or get better. And I think we've had our best times. I don't enjoy saying it, but I think it's true. And I don't enjoy saying it to my kids. But, you know, the U.S. coming out of World War II was in the best shape in the world. We had the best of everything. We had an intact infrastructure, and we had great advances on the business side and on the science side. And we used to say, you know, when people were questioning why we were doing better technologically, our explanation was that our German scientists were better than the Russians' German scientists. But if you look at, you know, and I imagine a lot of people saying, well, when are we going to get back to normal? Like
They ask that question.
Like the 90s. And when I look at the 90s, it was the best of times. The economy did well. Companies did well. Management advances. Technological advances. Productivity advances. Inflation under control. Interest rates declining. Peace in the world. And it doesn't get better. And if, by definition, it doesn't get better, then there's a good chance it gets worse. Now, the other thing is this globalization is a very, very strong force. And, you know, when I was a kid, there was no such thing as a foreign car. I believe that the first Volkswagen came to America in '49, and I believe, if I'm not mistaken, they sold 2 that year. You can look it up. But all cars were American. And when you don't have open borders, then the workers in one country can be paid more than the workers in another country, even if the product is not superior. And that was the case. And I believe, for example, that the American car worker was the best paid car worker in the world, and he didn't make the best car in the world. And it was the latter fact that permitted the vacuum to be filled by foreign cars. And so I believe that, I said in the past, and I think it became true, that the American car worker would have to accept a declining relative standard of living. And I think that's true. That's just one example, but I think it's true many ways in our economy.
So globalization is one of the factors.
Very strong.
Or
Automation.
things on your mind as you look into the future and come to this conclusion that
Yes.
perhaps it's not, or probably not going to be as good as the past. What else do you worry about? What else, if you will, factors into your equation?
Well, when you combine globalization and the vast numbers of people abroad who want jobs and it will work cheaper than Americans, and you combine that with automation, which is a much stronger force than job losses that we hear about so much in this election season. You know, automation has been an enormous factor. You go to a factory that 20 years ago had 100 workers, today it has 5. And they don't make any of the stuff, they only keep the machines going. And I despair about where the Americans who worked in agriculture 100 years ago in the South and then moved to the Midwest to make cars and appliances 50 years ago, I worry about where they're going to find jobs. And this is a question that is not easily solved.
Can you draw a straight line, or at the very least connect the dots between the future not looking as good as the past in qualitative terms and the future not being as good as the past in quantitative terms?
Well, I do think that we will grow more slowly in the future than we have in the past. And I believe that will deny opportunities. It'll make it harder for government to do things. You know, I wonder, why did we live so well 60 years ago? We didn't have deficits. We had good public schools. They were clean. I went to a public school. I got a good education. Why can't you do that today? Why can't we build infrastructure in this country and so forth? You know, so I mean, a lot of it has come from a declining growth rate and from the inroads made by globalization. And now, the good news is that, and I travel a lot, and it's clear that the U.S. economy is the envy of the world. And so the things I'm saying are not only relevant to the U.S. We're in better shape than, I believe, Europe or Japan, for example. But everything is slowing down. Everything is complicated by globalization and automation.
You've been on the record with me as saying you're no fan of Donald Trump and don't plan to vote for him. But, and I ask this question sincerely, if you're going to support Hillary Clinton, which I take it you will, does she have ideas, a plan that you support, that you think is realistic to address these issues that you raise?
I haven't heard much that convinces me, but I believe that she's, well, what did your boss say? Sane and competent. And I believe she will surround herself with good advisors, and I believe she understands the need for good advisors, and that she will work tirelessly and long hours of study to come up with plans. She is not the candidate of change. And we need change. And I think the idea of change is a good one. I'm not crazy about the current messenger of change. That's the problem. And, you know, if there were another candidate at another time who had a message of change and the competence that Mike Bloomberg's talking about, I think I'd be all for it.
I don't want to dwell on politics, so let's go back to this idea of turning a qualitative impression into a quantitative expectation.
Yeah.
As you point out, the 1980s were pretty good to investors, the 1990s were pretty good to investors, until 2008, the 2000s were pretty good to investors.
Well, except for that little patch.
That little patch.
Yeah.
And since the financial crisis, investors have made a lot of money. Over the past 30 years, equities have returned on average 9.8% a year, high yield 8.4%, mortgages 6.6%, and treasuries 6.2% in the great bond bull market. It works out to a, if you will, mix or balanced portfolio return 60-40 of something in the order of 7.5%. Exactly, more or less, what pension funds have been targeting and for the most part continue to target today. If what you say is true, that is an unrealistic target. What is a realistic expectation?
Well, Eric, the first thing that I'm pretty sure of is that 5.5% high-yield bonds are not going to deliver 8.6. And 2% treasuries are not going to deliver 5, and so forth. And the biggest mistake you can make, in my opinion, is buy a 5% bond expecting to make 7. So today, high yield pays 5.5. Most people expect stocks to deliver 5 or 6. High-grade bonds pay 3 or 4. Treasuries pay 1 to 2. You average those together, and you throw in, as everybody is doing, and as I think they should, something called alternative investments, be it distressed debt, private equity, real estate, or something like that. And I think you can do 5.5.
Now.
From today.
For the next 30 years.
Well, I mean, it's a long time. I'm not going to do it for 30 years, but you might. I mean, going forward in some indeterminate period, I think that it's 5.5 strikes me intestinally as the most reasonable expectation for long-term returns.
That's a big problem for this country, isn't it?
It's a big problem because most endowments need 8, charities need 8, and pension funds need 7.5-ish. You know, I meet with a lot of pension funds, and they always ask me my view of the world, and I give them my view and what I think, what assets are attractive, what I think they can make. And then they said, well, our actuarial assumption is 7.5%. What do you recommend? And I say, I recommend you change it. But the problem is that the actuarial assumption, which I think is supposed to be the return you think you can make,
right,
has morphed into the return you need to turn today's assets and predictable cash flows into the amounts you'll need in the future to pay to meet your needs. It doesn't necessarily have anything to do with what a prudent investor could make.
Howard, I think the audience would agree with me that there's nothing we want to change about talking to you. Thank you so very much.
Thank you. Thank you.
Howard Marks of Oaktree Capital.